The Federal Reserve decided to pause interest rate hikes for the second time in a row, keeping the federal fund rate at a range between 5.25% and 5.5%. Joining me now is David Strzewski, CEO of Sound Planning Group. David, welcome back. So the Fed has already raised interest rates 11 times since March of last year. So borrowing costs are at a more than 20-year high already. Did this pause come as a surprise to you?
No, it was not a surprise to me. And you know, the market essentially had about 100% probability that he wasn't going to be raising rates. So anyway, I think that we're probably, looking at this higher for longer. We're just going to probably remain sort of steady here unless we see inflation really tick back up. I don't think that he's going to, be raising rates. He's waiting for the lag effect to come in. Because there's typically 12 to 18 months between when these rates actually rise and how they actually impact our economy. We haven't hit those moments yet.
So the economy is, as you know, still grappling with the effects of the higher borrowing costs that, we briefly discussed. Home loans, business loans, for example, are more expensive. It seems that affordable borrowing now is the thing of the past. What do you think?
Well, I think that credit used to be cheap and it used to be plentiful. And I believe that those days are gone. Probably not going to be returning either. And this is a real, sad reality because, most of America's wealth is in our homes, especially for the average American, the middle class family here. And so what we're going to be seeing right now is price has to give if these interest rates remain above 8%. Like they're sitting at right now. So I actually do not see the Fed dropping rates in a meaningful way right now. I mean, it might happen if we go into recession, but I believe that that's going to be short-lived because we're going to have to be dealing with so much more inflation that's going to be coming relative to the print and spend economics and strategy here of the current administration. So, Milton Friedman gave us this information and he said, if there's an economy that's printing a bunch of money, this is the economy where inflation is going to occur. So we see a tremendous amount of inflation coming right now, and it's not going to be tapering. Why? We're deficit spending, $2 trillion just to keep the doors open right now. That's an unsustainable course here. So, the corporate debt that we have today is also a considerable thing to be looking at as we look at 2024. There's about $1 trillion every single year that has to be remetabolized. The small local regional banks have, generally speaking, been the ones that have metabolized this corporate debt. So, these 5 to 7 year loans come due. So they either need to be paid in full or they need to be refinanced. And the challenge is that these banks don't have as much money as they did before. And the reason for that is because the Treasury is paying such a handsome rate right now. It's difficult for the bank to compete, especially with the fact that banks only have 250,000 FDIC and the Treasury is unlimited. So this just kind of spells this kind of moment where I believe that we're going to probably see margin compression as far as the profitability of corporations, as they need to, have more debt to continue to invest, as they need more debt to, continue to buy those buildings or do those things. So culturally speaking, there's some big changes happening right now. I just don't think go away tomorrow.
So you talked about houses briefly. So the average 30-year fixed mortgage rate is now at or over 8%. Do you see the Fed's interest rate pause affecting the mortgage rates that we've seen on a steady climb now?
I wish that I could say that I see that their pause is going to affect that. It could be that some of the big banks, get a little bit bullish about it. But honestly, I think that all banks are struggling today. And, of course, that really comes down to where are the challenges in the banks? Well, the banks were told that inflation was transitory. They put all this money in long dated treasuries. And so when interest rates rise, the value of those bonds go down. So they're worth less. The 10-year treasury, July 2020, was down to 0.55%. I mean, could you imagine you own a 10-year treasury that's worth 0.55 and now the new 10 years over 5%? You're operating in massive deficits and losses right now with that capital. And so, no, I don't think that it's going to be going down. The best thing the consumer probably has going on is a hope that we're going to have more 40 and 50 year terms for those mortgages that are going to be coming out, because that's probably the only way that we're going to be able to keep values at this level with our incomes not going up as substantially. For every 1% that interest rates go up, we either need 10% more income or we can afford approximately 10% less of a house. So we went from 3% rates now to 8%. that actually, the math on that tells you that there's about a 50% downtrend that needs to happen in real estate if things are going to be priced right. I don't expect it to happen that quickly because of how real estate moves and works, but that's the affordability conversation right there. It is just not affordable today, given our incomes.
Yeah, ain't that the truth? David Strzewski, CEO of Sound Planning, thanks for your time today. Appreciate it.
Thank you.